Most seniors have absolutely no idea this exists, and that's exactly why it's such a big mistake. Right now, there's a brand new IRS rule quietly sitting in the tax code that could legally keep thousands of dollars in your pocket. But almost no one is talking about it. No letters from the IRS, no headlines on the evening news, no clear explanation from the people who are supposed to warn you. And if you're 65 or older, this silence could cost you real money over the next few years. Not in theory, not someday. I'm talking about money you may already be entitled to, starting with your very next tax return. And here's the part that should really get your attention. This opportunity doesn't last forever. There's a countdown attached to it. Miss the window, and it's gone for good. No do-overs, no retroactive claims. That's why what you're about to hear matters far more than it sounds at first. This isn't one of those tiny annual tax tweaks that barely moves the needle. This isn't a confusing loophole that only benefits the ultra-wealthy, and it's definitely not a scam. This is a real change to how the federal government looks at senior income. And for the first time in a long while, it's tilted in your favor. Before we dive in, I'm George from Dream Visa Updates, and I spend my time breaking down money rules, tax changes, and government policies that directly affect seniors and retirees, especially the ones that are easy to miss or poorly explained. I do this because too many people lose money not from bad decisions, but from missing information. And what we're talking about today is a perfect example of that. So what is this rule? It's officially called the new senior bonus deduction, and it was introduced as part of a broader set of tax changes aimed at giving older Americans some financial breathing room. In plain terms, it's an extra tax deduction available specifically to people who are 65 or older. If you file as a single taxpayer and you meet the requirements, this deduction can be worth up to $6,000. If you're married, both over 65 and filing jointly, it can be worth up to $12,000. And I want to be very clear about this right from the start. This is not a credit, it's not a rebate, and it's not some gimmick that disappears in fine print. This is a legitimate deduction written directly into the tax code. Here's what makes this especially powerful. This deduction does not replace your standard deduction. It does not cancel out your existing age-based deduction. It stacks on top of them. That's the key detail most people miss, and it's the reason this rule is such a big deal. Normally, when the IRS gives something new, it takes something else away. You're forced to choose one benefit or another. That's not what's happening here. This is additive. It's layered. Let me show you what this means in real dollars. For a single filer who's 65 or older, for the 2025 tax year, the standard deduction is projected to be around $15,750. On top of that, because of your age, the IRS already gives you an additional deduction of about $2,000. Now comes the new piece. The senior bonus deduction adds another $6,000 on top of everything else. When you put all of that together, you're looking at roughly $23,750 of income that is completely protected from federal income tax. Before you owe anything, before tax brackets even come into play, that's nearly $24,000 shielded simply because you qualify by age and follow the rules correctly. Now pause for a moment and think about what that actually means in your day-to-day life. That's income you can receive without it increasing your federal tax bill. That's money you don't have to pull extra from savings just to cover taxes. Now, if you're married, both over 65 and filing jointly, the numbers don't just inch up, they leap. For the 2025 tax year, the standard deduction for married couples filing jointly is projected to be about $29,200. On top of that, because both spouses are over 65, you receive additional age-based deductions that add roughly $3,200 more. And then comes the new senior bonus deduction, which adds $12,000 on top of everything else. When you put it all together, you're looking at protecting over $44,000 of income from federal taxes. That's not a rounding error. That's not a small perk. That's a massive portion of household income that may never be touched by federal income tax at all. For many retired couples, that represents the majority of what they live on in a year. What makes this rule even better is the flexibility. It works whether you itemize your deductions or take the standard deduction. Most of the time, the IRS forces you down one path or the other. This rule doesn't play by those usual rules. It follows you either way. No trade-offs, no penalties for choosing one method over the other. But here's the critical part you need to understand. This deduction is not permanent. It was never designed to be permanent. As the rules stand right now, it only applies to 4 tax years. That means the window opens with the 2025 tax year and closes after the 2028 tax year. Once you file your 2028 return, that's it. Unless Congress steps in and extends it, which is never guaranteed, this bonus deduction simply disappears. This timeline is one of the most important details in the entire discussion because it turns this from a passive benefit into a strategic one. You're not just deciding whether to claim a deduction, you're deciding how to plan your income over a 4-year window. That's why understanding this now matters so much. Now let's talk about income limits. The IRS designed this benefit to help low and middle income seniors the most, so there are income ranges where the deduction begins to shrink instead of disappearing all at once. If you're filing as a single taxpayer, the senior bonus deduction begins to phase out once your income reaches $75,000. The deduction doesn't disappear completely until your income reaches $175,000. For married couples filing jointly, the numbers are higher. The phase-out begins at $150,000 of income, and the deduction fully disappears at $250,000. These ranges matter because many retirees assume that earning too much automatically disqualifies them, when in reality they may still qualify for a partial benefit. The phase-out works like this. For every $1,000 of income you earn above the phase-out starting point, the senior bonus deduction is reduced by $60. That's it. No complex tables, no hidden calculations. What this means is that even if your income is modestly above the threshold, you may still qualify for a significant portion of the deduction. So how do you claim it? This is where a lot of people assume things will get complicated, but the process is far more straightforward than most expect. The key is knowing that this deduction is not automatic. The IRS does not apply it for you just because you're over 65. You have to actively claim it when you file your taxes. When you file your 2025 taxes, which you'll do in early 2026, you'll want to use Form 1040-SR. This is the senior version of the standard tax form. On that form, there's a specific box where you indicate that you're 65 or older. From there, you'll complete a new form called Schedule 1A. This is where the senior bonus deduction is calculated and officially claimed. If you use reputable tax software, most of this will be guided automatically once you answer the age and income questions correctly. And if you work with a competent tax preparer, they should already be familiar with this deduction and include it as part of your return. Now, before we finish, there's one rumor that needs to be addressed clearly. You may have heard people say that this new senior deduction completely eliminates taxes on Social Security benefits. That claim is not true. This deduction does not directly change the rules for how Social Security is taxed. What the deduction does is lower your overall taxable income. And by lowering your taxable income, it can indirectly reduce how much of your Social Security benefits are subject to tax. Let me show you what this means in actual cash. A $6,000 deduction doesn't just sit on paper. If you're in the 22% federal tax bracket, that deduction alone can reduce your tax bill by about $1,300. That's real cash that stays in your account instead of being sent to the IRS. And if you're married and able to use the full $12,000 deduction, the savings can be double that. One very important warning. Whenever new tax benefits appear, scammers are never far behind. You should expect bad actors to take advantage of this rule. There will be phone calls, emails, ads, people claiming they can unlock this deduction for a fee or rush your claim before it expires. Please be extremely careful. You do not need to pay anyone just to claim this benefit. The forms are provided directly by the IRS, completely free. If someone pressures you, demands upfront fees, or claims you need to act immediately through them to qualify, that's a red flag. This deduction is claimed when you file your taxes, not through phone calls or special programs. As we wrap this up, remember this is a 4-year window. That's it. The opportunity begins with the 2025 tax year and ends after the 2028 return is filed. After that, unless Congress changes course, this benefit disappears. The real mistake wouldn't be making a wrong move. The real mistake would be doing nothing simply because the rule felt confusing or because no one explained it clearly. This benefit was created specifically for seniors. It exists to reduce pressure, not increase it. So take the time to understand it, make sure it's on your radar, and don't leave money on the table simply because the information arrived quietly.